Good morning. This is Christy Somerville, CEO of Balanced Comp, and I have with me today Scott Richardson, CEO of Isiah Financial Group, and this presentation is on how to pay your CEO. I always, there were 15 people signed up, but there's some real advantages when there are only two, or three, because we can kind of tailor this to your interest and kind of where your questions are on the topic, because it never fails to be a very sensitive conversation. And also, I think it's a conversation that requires some education, and that doesn't always come well from inside the organization. Meaning, like I just left a client in Denver, and the head of HR, of course, who reports to the CEO, had been telling them very similar things, the board, as what I shared with them, but because they report to the CEO, there's always a question about how vested are you in the answer, because it also relates to executive compensation as well. And so I think sometimes it's easier to let outsiders kind of educate people on the topic, don't you, Scott?
I absolutely do.
And that's one of the reasons why I think we host this educational format on the topic, so that people can just send, like, okay, don't take my word for it, just go to this webinar and let them kind of drink the Kool-Aid on their own. I think that can be kind of helpful. So let me introduce Balanced Comp, and then I'm going to go through cash compensation, and then I'm going to hand that over to Scott, who will be talking about supplementary executive retirement benefits and all you need to know about that. Balanced Comp, I've been doing this work with financial institutions for about 19 years, almost 20 in January, because I remember when we were in DOS and we were changing over to Windows, and we were like, is the world gonna fall to January 1 of 2000? So about 20 years of doing this just with financial institutions. Really, we're in the small to medium size, 100 million to 15 billion, and probably the average is 1 to 2 billion, or maybe a little bit less than that. And we develop salary ranges from the CEO suite, which is what we're talking about today, down to what used to be the scanning operator. You don't see those so much. We do all the calculations for base pay and the incentive amounts for each peer group. We put that inside of our web-based system. You guys know that. I know at least 2 out of 3 of the attendees today are actually clients. So we put that into our web-based salary administration tool and tie that to Balanced Results, our performance management system. And then we work with boards on CEO compensation and performance plans, because I brought you some numbers today. That's great. And we're going to talk conceptually how you tie that, but really numbers aren't a plan. Numbers are just numbers. It still leads you to, if you just have numbers, you come out in December and you say, well, what should we do this year? I don't know. Does that seem like a good number? What did we do last year? Well, they're not doing much down at the hospital or the state or whatever, and things that kind of get off kilter, lack methodology. And then we also have the National Salary Survey for banks and credit unions. So if you're looking for one, you can go out to you can go to balancedcomp.com. So our agenda today is to talk about, I'm going to talk about cash compensation, and then Scott's going to talk about the retirement benefits. So we've got to start with a roadmap. It doesn't do any good to just jump into the survey books. If you haven't gotten the board to define where they want to be relative to market, man, your life will be easier if you can get that pinned down, because now you can take them back to, wait, but you said this is what we want to do. Like I was in Denver yesterday talking with the board about CEO compensation. And they said they want to pay competitive to market. But the current CEO was about 17% lower than the minimum of the range. Now, maybe that's right or maybe that's wrong, but one thing it darn sure isn't, it isn't at market. So we've got to pin them down to what is your compensation philosophy. Can we create a standard that you can audit against? Is there echo in here, or am I just hearing it? Am I sounding okay to you guys?
Yeah, you sound fine to me, Percy.
Okay, good. I didn't want a lot of, I know how annoying it is to listen and hear a lot of echo. I'm not saying that you have to be at market on all three, but you need to know where market is so you can define where you want to be relative to market on base pay, on incentive pay, and on benefits. Sometimes a board will have an easier conversation. Well, sometimes they'll say, well, we've got a really rich benefit plan, but nobody is paid any variable pay or incentive pay. That's not right or wrong either, but it's not market. And so I think that's really important. Sometimes they'll have base pay, they'll have a bonus, and then they don't have a cert, and they're $1 billion in asset size. Well, that might be okay, but guess what? It's not. We can all say it together now. It's not at market. So having one component down, being at market on base pay but offering no incentive pay, or any of those components, having one piece down but not the other, for your asset size, and that requires a little data there to know where is market. So if you start hearing conversations about what they're doing down at the city, how much a raise the teachers got, what they're doing at the hospital, those are interesting conversations, but they have nothing to do with the topic today. Some of the things that get in the way, and I say this because I live in this world, so I understand this. Board members, one of the biggest hurdles is board members who look at their own compensation. I'm going to show you a quick slide here. I don't know if you can you see my Excel spreadsheet? Say yes, somebody. Can you see my Excel spreadsheet?
Yes, it's kind of small, but I can see it.
Okay, well, we'll get into the details here, thank you, here in a little bit. But I guess the reason I slid that over is there are a lot of, this is the data for calculating the midpoint for the 1 to 2 billion asset size net nationwide before the number's been customized to a location. There are a lot of board members not making $469,000 and $469,677. To them, they're looking at that number saying, are you kidding me? So it can be hard to wrap their mind around that. And then you want to talk about bonus too, and they're just coming unglued. Well, we've got to frame the conversation about what is your industry in your asset size, and then tailor that market to your market. That's the only conversation on the topic, on the table, right? Other hindrances are, it's the way we've always gotten it done. Oh my gosh, sometimes they start splitting hairs. Well, what about performance? How do you tie pay to performance? And so they can get derailed a little bit and say, well, we need to look at the data for CEOs that have a similar loan to share or a similar efficiency ratio. Nope. Those things will tell you where in the range, but if your CEO was gone, you would get resumes and consider interviewing people, from the market, not just those that have a similar loan to share. Besides, when you start doing that and you look at how many respondents filled out the data and you have like 4 or 5, that's obviously not enough to base a salary administration program on. Unstated salary administration guides. That goes back really to the slide I just said. What's your comp philosophy? Have you defined your peer group? How long should it take you to midpoint? When are you going to change over? And then adding in benefits and perks incorrectly. Once in a while, it happens, once in a while, they'll look at a number like the number I just showed you on the screen, and they'll say, yes, but that includes benefits and perks. No, No, it doesn't. There's not a single salary survey in the United States that throws all that information in one. You do need to look at all the components, but you've got to look at them separately first. Any questions about or comments or amens about what I've said so far?
I love
I'll
it.
say an amen if you're asking.
Okay, there you go. It's Christmas time. Okay. All right. I am sorry if I sounded a little preachy about that. I think it's because I just got back from Denver. So, sources of data. If you're using one source of data, if you're using two sources of data, let me just ask you a question. If I called you up and I said, "Hi, Mike Randall, I'm Christy Somerville, and I'd like to be your compensation consultant," and you said, "Really? What kind of data you have?" And I said, "I have one or two sources," how fast would you get off the phone? Hopefully quickly. But yet, in all my polls where I am polling HR people on how to build your salary ranges and grades, when I ask them how many salary surveys do you purchase annually, the average answer is 2. That's not enough data. So we're recommending the American Banking Association, the IRS. You can read all these. We actually have raw data. Ooh, that's 275 clients now. I need to update my screen. We have a salary survey. So if you're a credit union, you have nothing to fear by using bank data. And I'm going to prove it to you here in just a moment. I think it's the next screen. Let's take a look. It is. Look, you might have board members that are like, "Oh, that banking data is really raising that." Would you look at the difference at 200 million all the way down, 254 versus 255? That's not even quite $1,000 difference. Here, the next asset size, $4,000 between a bank and a credit union. Remember, these banks also have a lot of commercial lending. They're not limited to 12.25. So the complexities of their underwriting, the complexities of their compliance are very great. And there's really no difference, no statistical difference in how they pay. At the next asset size, hey, guess what? The next two asset size, credit unions pay a little bit higher. Not statistically a lot, but a little bit on base because their incentive amount is not the same. So you honestly have nothing to fear by adding in, and the reason I think you should is because if you if you're doing a search for a CEO, you're probably getting resumes and considering candidates, if you look at the statistics, from community banks. And community banks, you're doing the same thing. So using ample data for credibility, for buy-in, to show that you're genuinely doing the research is very, very important. So does this surprise anybody how close you are now? We have a credit union system and a bank system, but you've known for a long time you're paying tellers the same. You're paying branch managers the same. I mean, does this surprise anybody that at the CEO level, there really is no difference in how you pay on base pay? Anyone surprised?
No.
Okay.
Christy, do you know, can you think back 5 years, 10 years ago, how big of a difference was and when that really started to merge?
I'd say 20 years ago there was a difference when I first started, but even 5 years ago, because one of the pushbacks I might get from a board is, well, I don't know if we should be adding in that bank data, and they might wonder if I'm trying to enhance the numbers, which on its face I would never do, so that's kind of an integrity issue. But I can tell you for the past 5 years there hasn't been any really statistical difference. So I can't tell you when it started, if it was 10 years ago or when, but there used to be a difference. It's just not the case. Unfortunately, most board members at credit unions have been on the board for a long time, so they're probably still thinking back to 20 years. So, yeah.
Thank you.
Now, what is that? Before we get into this, I want to spend a little more time. I just kind of decided this before. Instead of giving you an example, I want to show you, this came right out of our compensation director's worksheet. So I really want you to see how you determine the salary range. You've got to have enough data, okay? Notice, you might take the time to notice how many people filled it out, right? So I would think a 220 number is probably generally better than a 79, except for this came from 100% of all the 1 to 2 billion state chartered credit unions. So, I mean, no one's embellishing their numbers for the IRS. And get a load of this. This fascinated me. They had the highest number, and that came off of their W-2. So you know for a fact it's reliable. So the idea that CEOs are, I've got a military board at one credit union. I feel like I'm jumping on credit unions today. I'm sorry. But the military board is like, I think these CEOs are embellishing their numbers for these salary surveys, and that's what's right. Well, look, the ones that come off the W-2s is statistically higher than the surveys that were completed. So that fallacy should fall to the side. And friends, this, the IRS 990 data, the last time they published it was 2017. I had to trend it to get it to July 1st, 2020. I had to trend it for 3 years. So looking at it that way, these surveys are all 1 year old or less. The 3-year-old number from the IRS 990 is much higher. So when you have this many sources saying the same 440, 486, 420, 450, pretty soon we just got to stop saying the surveys aren't right. When you have that much data, and that's your key. If you really want to DIY this and do it yourself, you got to have that much data so that they can finally, and it was such a blessing in Denver when we're like, finally, okay, whether we like the numbers or not, we believe that they're real. There's too much, it's too compelling to say it's not true, okay? So then you have to trend that number to, you don't want to make a 2020 salary increase decision based on 2019 salary data. And the surveys are moving, the salary market rate movement is about 2.5, so depending on when it closed, you'll want that much of that many months to get it to July 1st, 2020. After all my experience, I usually rate it on a scale of 1 to 5 on which I think is the most reliable numbers. And so I'm going to weight it. This is the summation of my weights. I'm going to take a percentage. 4 divided by 46 is 8.75% of that trended number. And so I'm going to take a piece of each survey. They're not all created equal. That's my national average, and you might be surprised, like, why are we looking for national average? You have to make it statistically reliable. The maximum of that's going to be 125% of that number, and the minimum of the range is going to be 75% of that number. But before it's relevant to you, you might want to take it times the geographical wage differential for your market. And if I don't have your numbers up here and you want that, let me know. Now, here's another thought that I'm kind of dawned on me, really. If I lived in Columbia, South Carolina, and the Columbia market pays at 94% of the national average. So if I were a $1 to $2 billion credit union, I would take that number I just showed you, the 469 times 94. But there's also the rationale that if I'm going to do a national search, maybe I should use the national number, because if that's really how far you have to go to recruit, it makes some sense. If your geo is less than the national average, you might ask yourself, I don't know that it's a clear-cut answer, but certainly deserves some thinking on, should I use 100% of the national average for the CEO position for national search, or should I use the geo for my locale? So good question. Good, something to think about. All right. Any question about how you take national data and make it right for your market? Because that is the single most important conversation and win with a board is, can I believe those numbers? And I don't fault anyone for questioning numbers. That's their job. They don't want to be sold a bill of goods. They need to be fiscally responsible. But that is how. You're not going to find 4 surveys in Columbia, South Carolina that would make you feel like, okay, I have enough data. Does that make sense? Okay, so we can skip that. All right. So then when you have your number, in this particular case, I'll just show you, the national midpoint was 297. If you took it, if you lived in Casa Grande, Arizona, you're going to take that times 0.985. That's your true midpoint. If it's in San Jose, you're going to take it times 1.24. That would be your midpoint, and the maximum is 25% above that, the minimum 25% below that. It's not, after that, that's just math, right? You need a grade 9 comp analyst to do that and enough data. But then it's where in the range should they be? So typically, if your philosophy is to pay competitive to market, remember I said we have to start there. If a CEO has 5 years of average performance, average, normally their base pay would be at the midpoint. Because if D. Hilton calls them and recruits them, they'll be happy to pay them the midpoint if you let them, you know, have 5 years experience at your place. And if you hire someone with 5 years experience, you're going to have to pay that and above to replace them. So it's about moving them through the range. And remember, if you had a new one, and let's say you started them at 80% of the midpoint, well, the next year the midpoint's likely to move about 2.5%. And so that's what the problem, you know, here's a 4% jump plus the market rate movement. So if you get really behind, it's really hard to get them caught up. The conversation this week with the CEO that was underpaid was, well, gosh, that's going to take $70,000 to get them to where they should be, and that's a big number. And that is a big number. And I'm not saying they shouldn't look at that, but I'm saying that should never have been the conversation. If they had been paid within the range, because look how that affects their CERP. Look how, if you average the last 5 years of their salary, look how much that affects their 401k contribution. I mean, there are big impacts. So, and then if you change to the next asset size, and they're already low in the first asset size, you've really got a mess. I wish I could tell you in my 20 years experience how many times I've seen a retiring CEO go out at a salary that was less than the CFO that they promoted, who'd never been a CEO before, because they would be paid low here at 80% of the midpoint, and the guy that went out that, or gal that raised them up several $100 million in assets was making less when they got out. And that doesn't feel right, and I don't think it lines up with really your values or best practice or anything else. Where truly, if you have a methodology in place, you just keep up with it. And that's not a philosophy just for good economies or bad economies, but just in general, just a good way to maintain your fiscal responsibility in terms of compensating your CEO. Now I've brought some data for credit unions and execs. I won't read all this to you, but I will say that these slides are available to you for the asking. And I went ahead and gave it to you for department heads and senior execs as well, because the CEO incentive plan typically will trigger down at least to senior executives, okay? And when you see two numbers, it's because one is the median and one is the average. And when you see one number, they were so close on top of each other, there was literally no difference. So I like it when it's, you know, that's pretty compelling information when their numbers are that close. And then for bank executives, you can see, now that's where they compensate differently is on the bonuses, And then, of course, if there are equity programs. Any questions about what I'm showing you? And remember, yes, go ahead, Debbie.
No, I said it makes sense. Thank you.
Good. Any number I give anyone, I had better be prepared to back it up because I'm going to be asked for that at any time. And that's why I kind of like my work is, yes, there is some art to it, but really the art part is more what kind of plan are we going to create to tie that to that bonus so that they have to earn it every year, right? All right. So now I'm going to talk a little bit about the executive or the CEO incentive plan. I suggest having a plan where there are at least 3 components. One of them is a board evaluation that would be an anonymous survey that board members complete, answering 5 to 7 questions on a Likert scale from strongly disagree to strongly agree. And then all those are compiled so that it's not a witch hunt. And that number is multiplied times that percentage. When this is 50%, then you've got someone who doesn't want to make changes, who just wants to make sure everyone likes them. And you can't be effective if that's your goal. Your corporate goals, probably 5 to 7 corporate goals, are usually weighted between 60 and 75%. And you have the option, not everyone, it's not appropriate always, but you could have the board assess key strategic projects that are designed to move the dial. So that would be important. Here's another example of a CEO bonus for that 60 to 75% on corporate goals. And I like this one because you've got positive, like you can, in other words, you can hit, if you hit level 7, you get 100% of that 20%. But if you hit level 8, you can go 150% of that 20%. So you've got some real upside potential. So that positive motivation is there. But you also have negative motivation that's at work as well. If you hit a level 3, we're going to take off 33% of that 20% on what your payout would have been. So that's really got some good things going for it. The numbers in red are where in this demonstration I said they attained. So at level loan growth, they hit level 6. On delinquency to charge-off ratio, they hit level 3, so forth. And I've added the board evaluation in here as well. That's for some of you that have a corporate incentive plans that go all the way down to the non-exempt level. You might want to consider adding in the performance review score so that your high performing and your average performing don't get the same payout. So this can go all the way down through the organization. And then look at the results. Here again, here are the goals, here are the weights, the performance level. Here's the percentage of the goal that was attained, the number that was assigned. Here's where they lost out a little bit. Here they, oops, I'm going to go back. They just hit the budget, so they didn't get anything. So this CEO earned or accomplished 51.35% of the plan. So if the current salary was $250,000, and if the median target incentive for your asset size was 20%, then there was $50,000 on the table. They achieved a little over half of it. Here's what the payout is. In my experience, what's so interesting is maybe they would have given him a $25,000 bonus anyway, but now they know why they did, and they know, the CEO knows why they didn't get the whole thing. And it takes the monkey off the back of the chairman and the compensation committee because there's a stated plan. And it's just healthy. If you don't know what the board's going to do until the end of the year, then you tell me how motivational that was during the year. You didn't even know what was on the table. It couldn't have been motivational. This can be moved down to the executive level, maybe changing the weights, maybe adding in their performance review. And I like that you can figure the cost the total cost of one goal if you threw out the whole organization. Like if we hit this one goal, how much would that cost the whole credit union or the whole bank, so that you know, did we weight it too high or too low? You do need a plan document. You may want to consider some do or die thresholds to actually activate the plan. Like we don't even have a plan unless our net income is, you know, $750,000 or whatever. Clawbacks, regardless of fault. Are you going to use a consultant? You might be, the consultant should report to the board, because the board needs to be confident that this is not a hired gun that has been brought in by management to twist their arm into paying out some more money. And the only way that can happen is if that's their consultant. A stated peer group, do they have to be employed at the time of payout? So there are some documentation that you need to think about. I brought you some additional information on compensation trends this year that I think is very important. Not on topic, but still my chance to get it into you. And then I do want you to know that if you want a report that's customized on CEO pay, you can use this code and go up to whatshouldipay.myceo.com. I'm going to tell you, don't do it until next week, because we're updating for 2020 data like next week. They're finishing it off right now. So don't do it now or you'll get the 2019 report. If you would like, if the board is interested in working with me on building a CEO compensation performance plan, it's generally $7,500. And we have a new survey on our website. I know you're all like, ugh. No, listen, this one's cool. It's just about the mortgage loan officer and the commercial loan officer. It'll take you 20 minutes to fill it out, because you've always asked me how much to pay, but I couldn't tell you what the plan design was. And this is going to give you how many basis points, how many tiers, all that kind of information. And then also, if you're looking for a hard copy survey, you can purchase that on balancecomp.com as well. Okay, guys, that's all I've got, and I can turn this over to Scott Richards. Scott, that might have been my record time for you.
Yeah, that was very efficient. Yeah.
Let's see. Can you take it over?
Not yet. Yeah, it still says you have to make me the co-host.
I'm clicking on Manage Participants, and it's.
Make sure it's the first me at the top.
Okay, that's good to know.
I show up. Yeah, I show up twice. The other one, I think, is Chris.
Oh, there you are. Okay, the first one at the top, and okay, you are the host. Go for it.
Let's see. I can share. There we go.
There's that guy. Hello, handsome.
Thank you. And although the picture's older than it should be. Well, good morning, everyone. Afternoon for those who might be East Coast. Thanks again for taking your time today. So Christy did a fantastic job, as she always does, laying out the process for building up cash compensation element of total comp. But you really need to think about a bigger picture here. So allow me to digress for about 90 seconds and give a brief promo for Isiah. I've been in this industry for 30 years, focusing on financial institutions for about 20, and started Isiah 10 years ago this month. And our mission is very simple: value people, improve earnings, and protect assets. We help our clients value people through non-qualified executive and director benefit programs. Collectively within our firm, we've been involved in designing over 1,000 of those over the last 2 decades. Improving earnings comes through programs like BOLI. We have some sustainable fee income programs that 50 or so clients have enjoyed or implemented and continue to enjoy. And then when it comes to protecting assets, we look at things like key person, succession planning, the supplemental benefits that pick up where your broad-based group benefits leave off. So that's my commercial. Your challenge, the challenge really of every organization, is not unique to a bank or to a credit union, is how do you find, keep, and ultimately reward the people that drive the most value in your organization. It's somewhat unfair to say, but it's a fact, and that every organization has a few key players. Their positions tend to be more interchangeable, if you will. And as you get higher up the hierarchy in terms of skill set and position level, those become tougher and tougher to find and keep. So succession planning, I've been on the board of a community bank for a number of years. I've heard this from clients for even longer, that the regulators continue to talk about succession planning as a hot button. And they look at it from two perspectives. One is the hit by the bus scenario. What do you do tomorrow if Christy can't come in the office? And then the other one is longer term. What are you doing when Christy's ready to retire? And that is, it's kind of a sobering thought right now when you talk about and see all the M&A activity that's going on, both banks and credit unions. A fairly large amount of it is driven by the fact that you've got an executive team or a person who is ready to retire and there is nobody on the bench. And so by default, that becomes their succession plan, and that's not good. When you're doing all these things, again, pulling in the proper incentives, pulling in the different elements of compensation, which we'll show you in a slide, as important as it is to get cash compensation right, you cannot rely only on cash compensation. Somebody out there will always have a bigger checkbook, and they will lure people away. So Christy and I can't help you develop your culture that's centered around what mission you're trying to do, but we can help you develop the kind of holistic compensation program encompassing these elements. As we start to talk about the longer term elements that we specialize in, I can't emphasize this enough. There is no one best way. There are multiple ways that are out there. They are not mutually exclusive, and ultimately you want to find the one that's best for you, not the one that's best for whatever vendor is trying to sell you something. The science is fairly easy. We take it for granted, unfortunately, sometimes because we live and breathe it every day. The real fun and the real passion, I know for Christy as well as us at Isiah, is in the art, and that is bringing into the discussion what has worked and not worked for all the other clients that we've worked with, and that's the fun part of it. So when you think of total compensation, picture a stool, as I have here, and think of a three-legged stool, because two or one legs don't stand up very well. Yeah. The first leg is his current compensation. That's what we take home today. And you need to have a process, as Christy described, to make sure that that's benchmarked. And while we focused on how to do it at the C-suite level, it really goes down to all employees. You want to know, people want to know that they're being paid competitively to market. And for some positions, they'll tell you before you learn that you're not being paid competitively to market. At the same time, there's an old adage I learned 30 years ago that there's two things that work. It's us and our money. And so when we are ready to hang up the cleats or, put down the pencil, whatever euphemism you want to put in there, and retire, we need to have the ability to continue a lifestyle in some measure, and that comes from all the savings that we've been able to accumulate. So as an employer, you offer an opportunity. There's no guarantees, but it's really an opportunity to build on that wealth accumulation goal. And then lastly, again, this is to keep the wobbliness out of the way. As an employer, you've got a unique opportunity to affordably help your people manage the risks that can stop current income, stop wealth accumulation goals in their tracks. Think of illnesses, short-term, long-term, disability, death, those kinds of things. Here's the quiver. You have all these little bullet points potentially to pull out and deploy in terms of a holistic total compensation package. Christy spent the time talking about how to do the cash element, which is the salary, this year's bonus, maybe it's a multi-year bonus. We at Isiah focus down here in the right-hand side far more on the executive suite. And you'll notice that as you go from left to right, you go from plans that are meant to be for all employees to those that get more selective along the way, and that you have to limit them to a handful of generally executives. And in between are fairly straightforward things that are beyond today. So, again, trying to put this into picture, the cash compensation, the short-term compensation, I would say is at best a 2 to 3 year window. That's what you get to take home this year. Again, benchmarked, again, might have a multi-year salary, but generally it's an annual renewable sort of process. Intermediate term compensation is that stuff that you're putting out there and dangling out to your people that might be paid out in, say 4 to 10 years. And it's at risk. That's the whole carrot stick approach. It's at risk until they actually get to that point and receive it. And that's how you create some handcuffs or glue in the seat, different phrase. We see sometimes those called deferred incentive plans. Sometimes they're called stay bonuses. But it's a way to, again, stagger compensation into different buckets. The long-term one are those elements of compensation that are meant to be paid at the day somebody retires, or 10, 15 years into retirement. And those are the reward for being a key part of the organization for the long term, both commitments to both parties there. Those we see SERPs, Supplemental Executive Retirement Plan. Sometimes the name is a Salary Continuation Plan. We see REBAs, Restricted Executive Bonus Agreement, and split dollar loan arrangements. We'll expand on each of those here in the next few slides. So again, no one best way. Think of putting together a total package approach. Before you throw solutions at an unknown problem, we recommend really starting with what we call a disparity or a shortfall analysis. It should be the first step for anyone to do. And what this does is helps focus for you who in your organization might be most at risk, and this will become clear in a second. What amount are they at risk for, and then really understanding why. So here's the essence of disparity. So as an employer, you provide a suite of benefits at the moment, right? As an employer, you're paying for half the Social Security cost. The formulas will change, but half the cost is the employer, half is the employee. You're offering perhaps a 401k with a profit sharing element. You may still have a defined benefit pension plan, but you have these different programs that are paid for by the employer. And as the general rule is, if you start from right to left here, you have a rank and file employee maybe making $45,000 a year. As the level of income goes up with different positions, to an executive here making $175,000 a year, the amount of ultimate income that gets replaced in retirement from the same programs that you're providing for everybody goes down. Social Security was never meant to provide the same level of percentage level of benefits to somebody making 75 versus 150. It's regressive by its very nature. The same concept in the 401k and profit sharing plans. We have income thresholds that often kick in that prevent the same sort of contributions or matches and profit sharing elements. So understanding this is the first step. I can't tell you how many boards I've been in front of whose first thought is, hey, we want all employees to be treated the same way. And they're thinking that since everybody participates in these programs on the same terms, that that's treated the same way, but there's truly a disparate outcome that nobody can do anything about relative to those programs. It's baked into the tax code. So that's one thing to start with. On the other sort of tangent on this one is we have a lot of clients who they may have a very robust total compensation philosophy that covers not only the short-term cash comp but long-term stuff. And in that, they have an idea. They've determined that they want to provide and target a X% of final income from all sources when somebody retires after a career with your bank or your credit union. I can tell you this ratio is all over the board. We run across documents where it's as low as 15%, others where it's as high as 70%. You always got to peel back and see what else is going on. I'm going to mute somebody here. So, sorry. So when I see this, no, I'm sorry.
It wasn't me.
So again, that's a big range, and why is it so big? Well, a lot of this comes down to how things get documented at the end of the day. So whenever and almost every single time, I can think of one exception in 20 plus years, where I've seen a ratio at 65 or 70%. Has that not been offset by all of the other programs that you're paying for as an employer? So, for example, it might say our goal is to target a 70% ratio, less half the projected Social Security, half the profit sharing, half the 401k, or all of it, those things, less the pension plan, and so on. In those plans that have a 10, 15% ratio in some sort of document, if you really peel it back, that's the result of all the offsets. So you got to be careful what you're looking for and the questions that you're asking sometimes when you do these things. The bell curve, the old bell curve approach, I would say that most clients, if they're thinking about somebody or a replacement ratio for somebody who's been there 25, 30, 35 years, that after considering all of the other benefits that the employer pays for, that target ends up being in that 20 to 25% range. All of that discussion talks about and is centered around somebody who spends, as I said, 25, 30, 35 years. But what do you do with the new CEO you just hired when she's 52? I don't think it's your board's responsibility to make up for what she didn't get at a prior employer. And so oftentimes we have a mechanism, we talk about a mechanism to adjust for those short timers, if you will, to focus on how many years of service are they going to give to your organization, and focus on a replacement ratio based upon that. And the factors can be, 1.5%, 2% is about the highest we've seen. But for example, it might say, hey, we're going to take your final salary, we're going to give you 1.5% of that as a retirement benefit for every year that you work for us, and we're going to pay that over a 20-year period. It's a simple math problem at that standpoint. Any questions on a targeted shortfall or a disparity shortfall? I'm not sure how many people have heard of that, but to me, it's a best practices starting point in every case. Okay, good. So now you've figured out which executives you want to do something for. You've even gone so far as to quantify what it is you're trying to shoot for. How do you do it? If there's no one way, think of these ideas as a bookshelf, and you're going to pull one off and put one plan in for one executive. You might do an entirely different structure for a different one. You may have two structures for the same executive. You'll see why it makes sense to think of these things as interchangeable, or not mutually exclusive, but different advantages for each one. So again, on the wealth accumulation side of things, we're talking about deferral plans, the SERPs, REBAs, split dollar loans. On that risk management side, these are the protection benefits of the life insurance, the disability, long-term care that go beyond what you're providing on a group basis to all employees. Always nice to know where your peers have been, to know whether the trail you're about to head down has been blazed, or you're hatcheting your way through. Thanks to Christy and our friends over at Blanchard Consulting Group for different data here. But the big takeaway from these things is that many, many, many of your peers have evaluated this process and implemented either a 457 plan for tax-exempt credit unions, or split dollar loans, or straight up deferral and CERP plans. So very prevalent. In fact, the larger the organizations, the more prevalent they become. Someone asked me the question, and this is anecdotal, but when you see really small organizations and the prevalence isn't that high, I still run across a fair number of, I'd say the under $200 million credit unions in particular, who still have defined benefit pension plans. In those circumstances, when you have a defined benefit pension plan that's got a very strong formula and Social Security and other things, there may not be a strong rationale for some sort of executive benefit. That's why I think this percentage is still so low. We're seeing, obviously, those plans are expensive to maintain and fund. So first step oftentimes might be to freeze them, ultimately to terminate them, and then what are you left with? You got to do something. So be careful of the data. So 3 basic types of plans. The deferral plan, this is really easy. I, as an executive or from a compensated director, elect to defer some income. It's my money. It's very easy to implement. It's very cost efficient for the employer, for the organization, because it's not your money. It's the participant deferring their own. Because of that, there's not a very strong attraction, retention, reward value there. On the other end of that bookshelf is a SERP, which is the go-to plan for when we have disparity shortfalls. And because its simplest description, it's all the employer's money that's funding this. It's a promise to pay a benefit down the road that has very high attraction, retention, reward value. A REBA, Restricted Executive Bonus Arrangement, this is the first of the 4 types of structures that actually require the purchase of an asset. You don't have to have any assets to fund a deferral plan or a SERP plan. Those can just be managed on the balance sheet. A REBA requires you to have an insurance policy insuring the particular executive, owned by the executive actually. And the reason that's preferred used is because of the tax-free nature of the distributions. And basically the REBA is the employer is going to pay for this with no recovery expectation generally. Split dollar loan takes the idea of using a life insurance policy. This is the second one that requires an asset, one step further. Instead of just employer paying for it with no expectation of recovery, there's actually a built-in recovery mechanism. At the moment, split dollar loan is uniquely, I guess, primarily limited to tax-exempt organizations like a credit union, hospitals, foundations. We just don't see them in banks and haven't for about 15 years, and explain why in a slide. So basic design of a deferral plan, very simple. I make an election, your executives make an election, directors to defer something. Dollar amount, percentage of bonuses, whatever the case may be, and once that's deferred, you merely make a balance sheet entry in favor of, as payable to that participant, and at some point you're going to credit interest on that. I want some type of reward or some return on my money that I could otherwise take, so what are you going to give to me? And that interest really is the only cost to the employer initially. Very, very small on day one. You know, Einstein said compound interest is like the 8th wonder of the world. So be careful and be mindful and look at that 25, 30 years down the road. Your interest expense is often greater, you know, as a multiple of whatever the deferrals are in that last year or two. So just be mindful. Accumulated deferrals, right? You add up all the deferrals, you add up all the interest, and at some point down the road when you have these permissible triggers under the tax code, money's paid out. Fairly straightforward. If you're a bank, your technical limit is 100% of compensation. You can defer it all. But when we defer our own money, we're always vested in it. And so you have to pay FICA tax on vested compensation. So if you deferred 100% of it, you're going to end up paying your FICA taxes out of other funds when you file your tax returns. So the reality of it is that very few people can afford to defer 100% of their compensation anyway. And most of the time, it's going to be something in the nature of, you know, 75 or 80% when you got to keep some on the table for other withholding issues. For a credit union under the tax code, this is a 457B plan, and that limit is $19,000 for 2019 anyway. And that $19,000, whether it's 100% the executive making that deferral or 100% the employer putting that money in, that's the limit. It's a combined limit. So if the executive does 9, the employer could do another 10. That's it. Once we get beyond the basics, you start to think of, okay, how can we make this more attractive, more enticing? Can there be employer contributions? And of course, that does add to your expense. They can be in the form of additional matches, just to sort of mirror what you're doing in your 401k. I put discretionary on there, but I just don't think they work, so I don't like them. Nobody knows exactly why they got something. They're never going to tell you no thank you, but nobody really knows why. Instead, if you're going to add some element in here, why not expand your bonus plan, right? The incentives that you're using for your bonus plan, exact same incentives, and create an element that gets deferred. So you have some bonus paid currently, you have some that's deferred, but all of it based upon the same performance incentives that you're trying to achieve. And always, 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 employer contribution should have some vesting. That's the handcuff and the forfeiture that you want in there. Up above, I said the interest is really pretty nominal early on. Again, that's the only cost, but there's a very myriad of ways that you can credit interest on these things. It can be a simple fixed rate, 3%, 5%, whatever it is. We see clients tie it to an internal rate, either the best one-year CD they may offer on January 1st or 2nd, to ROE of the institution. We see external indexes pointing to a long-term corporate bond rate, sometimes S&P. Those things you really need to understand what those would do to the income statement on a long-term basis, and if necessary, put some caps around them so it doesn't get out of control. A salary continuation plan or a supplemental executive retirement plan. They're all the same thing, just different names. There's one of two approaches here. There's what we call a defined benefit approach, which is what most people are familiar with or should be familiar with. And that's a mere promise. Christy, if you stay until age 65 after spending 30 years here, we will pay you X dollars for 20 years during your retirement. It's as simple as that. We're defining the future benefit. The corollary to that, or the alternative, is what's called a defined contribution. And we have no idea what your ultimate retirement benefit is going to be, but the promise is something like this. Christy, if you stay until 65 and every year we hit these goals, same goals you might use for your bonus, by the way, we're going to set aside $20,000 or $50,000, but you're not going to get that until you retire, and even then it'll be paid out in installments for a while. So we're defining how we're going to contribute and build up the plan, but we won't know what it's going to be worth until you get there. Neither right or wrong, just different approaches. Regardless of which path you have, you got to comply with GAAP. And GAAP says you got to accrue your liability, you expense it on your income statement, you build up your liability on your balance sheet, and just like the deferral plan, when you hit the permissible triggering events, you can now pay out benefits to people. Generally, if you do this right, and it's very easy to get right, you don't have any income tax to the executive until they actually receive things. Or if you're an executive at a credit union, when you vest, you're immediately taxed. So hint, hint, distributions and vesting need to occur in the same year for tax-exempt employers. You might pay FICA along the way, if you got some vesting in there, but generally no income tax. We get into some of the design elements of, well, how should distributions be made? Should they be made in installments, 5 years, 10 years, 15 years, or should it be in lump sum? And is it a single lump sum on your way out the door? Is it 2 or 3 lump sum over the course of the plan? So all of those can be done. You just need to model them and make sure they achieve what you're trying to do. Great idea to have restrictive covenants in here, meaning that if you're not using these when you first hire your executives, you can add them in here, and they serve as a forfeiture, right? Because this is all the bank or the credit union money, and it would read something like, hey, we'll pay you this amount, but if you, within 2 years or 1 year after you terminate, steal our people away, go after our customers, those kinds of things in a competitive, harmful way, you forfeit it all. So that can be pretty powerful. Obviously, if you do a lump sum distribution upon termination, there's nothing to forfeit, so be mindful of that as you design those things in there. For people who like pictures, fairly straightforward. The thing I wanted to be mindful of, and we'll talk about in the slide, is this, the Tax Cuts and Jobs Act of 2017 did 2 things. Well, 3 things, I guess. It certainly lowered the federal rate for for-profit companies down to 21%. But for both, in the process of doing that, it actually eliminated the deduction for certain amounts of compensation. So when you pay somebody more than $1 million a year, that's not deductible. To try to create some parity, they impose a tax on credit unions, and this will come clearer in a slide or two, that also has in here. When you do a SERP in a tax-exempt credit union, it's far easier to cross over that threshold and create some unintended penalties, so just be mindful of that. REBAs, Restricted Executive Bonus Agreement. Again, we use an insurance contract because in the tax code, when we as individuals own this, we get tax deferred growth. tax-free distributions, and ultimately tax-free to our beneficiaries. There's nothing like it in the tax code. So under AREBA, you as an employer just make an annual renewable promise. You're going to pay the insurance premium each year that it's due as long as the executive is employed by you. If they're not, they take the policy on their own. They're responsible for their own premiums or some other adjustment that they have to the policy, but it's fairly easy. We don't want the executive just to have an insurance contract that builds up cash value. There's no restrictions there, so we actually put an endorsement. We go to the carrier with a contractual endorsement that says, hey, the executive can change his or her beneficiary daily if they wanted to, but do not allow access to cash surrender values until, again, it's a date, it's an age, however you want to agree to that. There's the handcuffs. Every time that premium is paid, it's an expense by the employer. It's immediately taxable ordinary income by the executive. Again, the tax-deferred growth and all those things, distributions tax-free. When I'm comparing a taxable SERP, the traditional 457F plan or a SERP in a bank, to a REBA, I can accomplish the same economic benefit to the executive for anywhere from 25 to 35% less expense to the employer. It's very attractive. Obviously, advanced design, now we can add vesting, right? So for credit unions on the call today, you know that if you vest, you have immediate taxation. Well, we can have some vesting without immediate taxation, mainly because we're paying it in advance, but we can create some vesting in here. We can create some forfeiture to have benefits peeled back if certain things don't occur. And then we actually usually see a gross up in terms of that tax cost on an annual basis. So picture-wise, that's how it looks. Again, the handcuffs are the big piece here. How long do they stay? When do they melt off? And at some point, the key is the executive has a completely unrestricted insurance policy that they can do whatever they want with. Split dollar loan takes that concept of the insurance policy just one step further. So rather than just paying the premium, expensing it this year, and also resulting in current taxable income, this now comes in the form of a loan from the employer to the employee. So just like when you borrow money for a car, for a house, that's not income. Same concept here. Tax regulations make it clear if you meet certain requirements, there's zero taxable income to the executive. And the first one is the employer has to be repaid interest. And the interest is set by the IRS, this thing called the applicable federal rate. And as long as that's accrued and paid, no tax consequences. The policy itself serves as the source of repayment. So we actually have a very strong collateral assignment on the policy to create the handcuffs there. Everything grows tax deferred, just like in a REBA. And when the time comes, we get the tax-free distributions. This actually results in the lowest long-term P&L impact, although it's got some hair on it. So question becomes is, well, when do we repay the employer loan? Certainly no later than death because the proceeds are there, but do you have a young enough executive that you can plan for an employer repayment in 15, 20, 25 years? If you have that opportunity, it's usually preferable. Do you accrue interest? Listen, just because the IRS says if you don't, you have taxable income doesn't mean you have to. We've got a client or two who have said, no, we're not caring about that AFR. We just want to put the money out, knowing that the executive has the annual taxable interest income or imputed interest income to report. Not a bad thing. We just model it out. And by the way, just because they say that you have to be repaid at the AFR, it could be more or less than that. Just need to understand the consequences. This is perhaps the biggest one because it comes with accounting considerations, and that is this whole concept of recourse. And, the employer lends money. If you lent out $1 million, for example, and your source of repayment is the underlying insurance policy, if the insurance policy is only worth, say, $900,000, for example, in surrender value, who is responsible for the $100,000 differential? If the executive is personally liable to repay that $100,000, that's called recourse. You've got to document that, and that helps you on the accounting side, that you have to no adjustments to your balance sheet. But most executives really aren't interested in being on the hook for that, and so you don't see recourse very often. And it just means that the employer has to adjust their receivable by that little shortfall. And it's usually an issue in the first maybe 5 to 10 years of a program, not too much longer than that. Again, big key there. We don't see split dollar loan in banks very much for a couple of reasons. One, in 2002, yes, we're looking back 17 years, Sarbanes-Oxley was enacted, and Sarbanes-Oxley made a loan to an insider a criminal transaction. And obviously that affects SEC filers. So even privately held or closely held banks may have enough shareholders that cause them to do SEC filing every so often. You don't want to do these because people go to jail. We don't see and haven't seen split dollar loan in publicly traded entities since 2002, but prior to that was very prevalent. Obviously, as a nonprofit, tax-exempt credit unions, hospitals, foundations, those kinds of things don't have that issue. For privately held banks, we haven't seen it really pick up even beyond the Sarbanes-Oxley issue because there's a Federal Reserve letter that predates the Treasury regulations on split dollar loan and is actually now in conflict with them. So until the Treasury Reserve updates that letter, you're sort of in a quandary. You shouldn't do these things. So we just don't see them in banks. But again, there's the picture-wise how this works. I mentioned this earlier, so I want to look at it again briefly here. The Tax Cuts and Jobs Act of 2017. By now, most of you have one full year. We're finishing our second tax year on this thing, but two big things. If you're a for-profit employer, so think for a bank, the trade-off for having a lower rate was you lost the ability to deduct compensation when it exceeds $1 million. There used to be an exception for performance-based compensation, and that's exactly what they limited because it got abused. So now if you're paying somebody, salary, bonus, all these other distributions, when the aggregate exceeds $1 million, you can't deduct the amount over $1 million. They couldn't take away a deduction from a tax-exempt employer because it doesn't matter because they don't pay taxes. So instead, they turn that into an excise penalty. So now if you're a tax-exempt employer, credit union, hospital, foundation, and you have distributions or compensation that exceeds $1 million, the amount over that threshold now has a 21% excise tax. It's meant to have the same impact there. And it isn't a fixed 21%, by the way. It just says it's the same federal corporate rate. This happens to be right now.
Isn't.
So the penalty, the loss of deduction to the, does not go to any participants here. That only affects the employer side of it. There is extremely limited grandfathering here to try to change plans if you have them in force. Obviously, if you're doing something new and you see this penalty coming at you, you either design it to avoid it or willingly accept it. And we've got clients who take both approaches. Big picture of these things, here's kind of what, from the tax perspective, if you're an executive, when are you going to pay income tax on these things? Right? Here's a SERP, you're going to pay them at the end. REBA, you're going to pay it up front. Split dollar loan, if done properly, you're not going to pay it at all. If you're a credit union, same kind of thing. The only difference here is when you pay the income tax. Again, vesting triggers taxation. So if you have a vesting date that's today and your plan says it's not going to be distributed for 3 years, you've got a problem. You owe income tax now, but you won't get the money to pay the tax for 3 years. So that's why we routinely see distributions in the same month that somebody becomes vested in a credit union world. If you're the board, I suppose if you're the executives too, is what's the hook? What's the glue in the seat? When can this be forfeited? Will you always have to pay something? And the answer is no. You can design these things to have longer-term retention issues, through vesting schedules, through forfeiture clauses, those kinds of issues. And by the way, this slide deck will be sent to everybody when we're done, so don't worry about trying to read these next two slides very quickly. This is another way to kind of compare the four structures there. Wrapping up here, let's talk about the risk management leg of the stool. And this is the disability, life, and long-term care. I've been, as I said earlier, 30 plus years in this industry, and I have done 3 times as many disability claims as life claims in that time frame. And people close to me, people not, clients, those things, you see it. Statistically, before any of us turn 65, the risk of becoming disabled is about 30% more than of dying in that year. So it's a pretty significant risk. Group LTD, group long-term disability insurance, is a fantastic foundation, but it leaves a gap. So first, if you don't have group LTD, you're leaving the easiest, least expensive benefit option on the table that you can put to folks. Call us, we can help you. But most people have one. And the typical group LTD plan might come out and say, hey, we're going to cover 66%. Sometimes it's 60, but 66%, for example, of base salary. But we're going to cap it. Sometimes it's a $6,000 a month. I've seen $7,500. Really large employers might get to $12,000 or $14,000 a month, but every single one of them has a cap. And so just do the math. A $6,000 a month cap at 66% means that all salary in excess of $109,000 for this example is not covered. And no bonuses are. No retirement contributions, nothing else is covered. So it's pretty common when you do the math to see your executives, and it may go further down the chain than you realize, to see them have maybe 40%, 35, 40% of their total compensation covered. And I don't think that anyone expects that outcome. So we have solutions to build the gap. And so here's an example of a client where we had to get a larger organization. They were targeting 70%, and here were the top officers. Current plan, because of the caps and limits, here we had the CEO, 15%. That's it. You know, even another executives up here were at 50. And so, again, we were able to find solutions to bridge that gap. Supplemental life insurance is similar, not as dramatic, obviously, in terms of some of the benefit shortfalls, but group term life, great start, but as the compensation grows, they often have limits. Small employers, sometimes you're stuck and you take the straight $50,000 limit. For those who can and do more, oftentimes you'll see a limit of coverage, 200,000, 300,000, maybe 500. We just did a plan, 120 employees, and the most they could get was 500,000 of coverage on a limit. So that's a guaranteed issue. So there's a limit to what you can do. Employer sponsored, and I use that term carefully, doesn't always mean employer paid. Right? As an employer, if you can offer to an insurance company a group of executives, you can, if it's the right profile anyway, you can get pricing discounts that are permanent. You can get underwriting concessions that are very favorable and make it easy to implement. So employer sponsored doesn't mean employer paid, but it's by far the best way to get coverage. And if you've got BOLI, that's the easiest of all ways to get supplemental life insurance to people who are insured through the BOLI. It doesn't cost you any more money, and it's an extremely efficient method to do it. And the last element is long-term care insurance. You know, this ebbs and flows in terms of its, it never goes away in terms of its seriousness, but it's really the product availability. The market over the last 10 to 15 years has gone through several unpleasant cycles, and so as carriers exit the market, it makes a challenge. Carriers come into the market, it creates opportunity. But here's the long-term issue, is we all are likely to need long-term care services. We're living longer, but we're not necessarily living independently longer. And so those issues that might have shortened our life 20 years ago are certainly not doing that today. So the services we're going to need, the cost is high. I put $7,000 to $10,000 a month. That's probably too low by now. And most of us aren't covered. First thing we think of is, oh, I've got health insurance. No, health insurance doesn't cover long-term care. In retirement, Social Security doesn't. Medicare does not. The only public program that covers it is Medicaid, which is a welfare program, which means you have to qualify by basically spending everything that you own, and then only if you're in a facility. So not a good answer. Again, employer sponsorship for both executives and increasingly board members. So, for example, credit union board members are, you can't provide life insurance if you're a federal credit union to them. That's right in the statutes. Life insurance is not permissible, but long-term care can be. So this is a great way to get coverage there. 3 different ways to approach it beyond the discussion for today, but those are the options. Thank you all for joining us. Again, thank you.
Thank you, Scott.
Take care.